2019 State Taxes, Pennsylvania Update and the Multistate Tax Climate was a live webinar that was originally produced on Wednesday, June 26, 2019. For this webinar, we were joined by Mark Heath and Lindsey Waltemyer from McKonly Asbury, and John Beck and Sharon Cody from Harbor Compliance. We hope you enjoy this recap, and please visit us online at macpas.com for more information about our future webinars and other events.
Hello everyone, and welcome to our webinar, Pennsylvania Update and the Multistate Tax Climate. My name is Lindsey Waltemyer. I'm a tax supervisor here with McKonly Asbury, and I am our state and local tax expert of the firm. And here with me I have Mark Heath.
Hello everyone. As Lindsey said, my name is Mark Heath. I'm a partner in charge of tax here at McKonly Asbury, and we're excited to be with you today.
And then we also have our friends at from Harbor Compliance here, Sharon Cody and John Beck. Feel free to say hi.
Hello, thanks for having us.
Hello, it's a pleasure to join you.
Thank you. Yeah, we're so glad you can be here today. All right, so first off for the agenda, we're going to start with going over the current Pennsylvania state budget and the overview, and that's a very hot topic right now as we're still waiting for the budget to pass, but it's getting close. We're going to go into highlights of recent Pennsylvania updates, tax legislation, and case law, and then look at how Pennsylvania compares to other states. Then we're going to shift the focus a little bit and go into the impact of federal tax reform on not only Pennsylvania, but other states as well, and the impact of Wayfair versus South Dakota on other states as well as Pennsylvania. And then finally, Harbor Compliance will give us an update on foreign entity qualification and annual reports. So first off, the proposed budget. We had an article on this back in February when it came out, a couple of the things that the governor was looking to accomplish. First of all, there were no increases in income tax or personal income tax or sales tax rates. So really no tax increases even in the proposed budget. One thing the governor had proposed was mandatory combined reporting for corporations, and as well as a reduction of the corporate tax rate to go along with that. That's something that he had proposed in previous years as well and had not had success on. Another thing that some people say has been long called for was a fee for municipalities that rely on state police for protection. Now that proposed fee was on a sliding scale between $8 and $160 per capita based on the number of residents in the municipality. That's something that did not make it to the budget that was signed by the House.
And for those of you who don't live in the tax world like we do, we kind of chuckle every time the governor's proposed budget comes out, because inevitably we always see mandatory combined reporting for certain affiliated entities and a reduction of the corporate tax rate, yet it never happens. I think it's been part of every proposed budget for probably at least the past 10 years. And the combined reporting, just to touch on that, what they're going after there is what are referred to as Delaware holding companies, where you set up a company in Delaware and you charge interest, you pay interest to this related party in Delaware. Delaware does not tax that interest income in Delaware, and you get a deduction in Pennsylvania for it. So it seems kind of unfair, and obviously many people think it is. However, a lot of the entities that are paying a lot of tax in Pennsylvania, maybe not income tax, but paying a lot of payroll taxes, property taxes, they're employing a lot of people, would be very upset if that went away and they lost that income tax deduction. So that's generally why we see that not happen year after year. And along with that, the reduction of the corporate tax rate, they kind of go hand in hand. If we're not going to get rid of the DHCs, then we're not going to reduce the corporate tax rate. So you would only see those happen. You would probably only see both of those happen, or neither of them happen, is what we normally see.
Right. So although we saw that it was true that there aren't tax increases in the budget that was passed by the House, it also did not have a bunch of these other provisions, such as that fee on municipalities, as well as that increase in minimum wage. That was a big big topic this year, was the increase in the minimum wage to $12 per hour starting July 1st, and then up to $15 by 2025. And that was something that was not in the budget that the House has passed. And then, not part of the budget, but one thing that the governor has, again, constantly, every year we see this, is the natural gas severance tax. It's not part of the budget this year, and it's an issue that's expected to be looked at in the fall, and the governor was looking at that to fund infrastructure, and that was his strategy this year. So just looking at the budget, now you hear a lot about this being a $34 billion budget. That is referring to the general fund. So the whole budget is actually made up of a bunch of other funds as well. And you can see there's federal funds there, as well as other funds, which have a whole variety of different types of funds in them, like the state gaming fund, tobacco settlement fund, all kinds of random items. But that's the picture of your overall budget. Generally, we only refer to that general fund. And then here we have a look at the general fund and where the revenues are coming from. I find this kind of a particularly interesting chart because you see most of the revenue here is coming from personal income tax, which we are a very friendly personal income tax state at a low rate of 3.07%. On the flip side, you've got the corporate net income tax there is only 9.7, even though we do have that high corporate tax rate. But again, that goes back to the mandatory combined reporting. We do not have that, which kind of lowers it as well.
That and the vast majority of businesses, not only in Pennsylvania and across the country, are flow-through entities, S corporations or partnerships. So all the revenue from those generated from those businesses would ultimately fall into the personal income taxes as opposed to the corporate net income. So by and large, the corporate net income tax does not affect that large a number of companies percentage-wise, and obviously then only makes up a relatively small amount of the revenue.
So in general, we do expect this budget to pass on time. That's what most people are expecting because the governor has said he would sign it as is. So we'll see what happens in the next few days here. The Senate's supposed to vote on it soon. And then just in general, we have an economic outlook in here. Part of the reason the budget's expected to pass on time is because we have this economic growth right now, and Pennsylvania is in pretty good shape. So that's kind of where those numbers come from. We're, expecting growth, and that's why we don't have any tax increases in this budget. So next we'll go into some updates for Pennsylvania, what's going on right now. So first of all, there was an increase in NAP credits, which is the Neighborhood Assistance Program. It's a program that encourages businesses to invest in projects which improve distressed areas in Pennsylvania. So it's where businesses are stepping in and helping out the community. The increase was from 18 million to 36 million, and applications are open right now, and they actually close on June 28th. So July 1st, those credits will start to be awarded. Then we have the second rollout of the department's modernization project of MyPath. That was a project aimed to update tax systems and improve technology. It's going to transition in mid-October, and it's going to include inheritance tax, realty transfer tax, and medical marijuana tax, and will provide a workflow system for the state's voluntary disclosure program. That's a whole lot of things. What I like to focus on is the next rollout, actually, because that will include the personal income tax and the property tax rent rebate programs. So that actually is going to affect more taxpayers, and that's expected in late 2020. So then we've got the PA reaction to Wayfair ruling. PA did issue guidance on this. I'm going to cover that a little bit later, so I won't say too much about it now, but PA was one of the few states one of the states that has issued guidance on that Wayfair ruling. And then another thing to touch on is that Nextel case. This was actually an update from the prior year, but we thought it was worth discussing because it is affecting taxpayers right now, and it's something that is new for a lot of taxpayers. PA previously allowed a deduction up to $5 million, and now it's only a certain percentage. It was 35% for 2018. It does increase to 40% for 2019. But ultimately, the result is that taxpayers who were previously able to use an NOL to offset all of their PA income are now not able to use the full NOL and will end up paying tax.
Yeah, to touch on that, I'm sure you're all pulling out your Nextel phones right now and doing that little bleep bleep with your friends to find out what happened to Nextel. So what happened was, as Lindsey mentioned, you used to be able to use your NOL carry forwards to offset either 30%, the greater of 30% of your taxable income, or $5 million. Nextel challenged that under the PA Constitution, saying it was an unfair treatment because you have to treat, under the PA Constitution, you have to treat all taxpayers equally. And unfortunately, they were right. I mean, it was kind of pretty clear cut that this was not a fair treatment, and the courts ruled accordingly and said, you can't do this. Everyone kind of thought that the Department of Revenue would say, okay, fine, we're going to remove the 30% limitation and say you can deduct up to $5 million. Well, they went the other direction and said, okay, fine, we're going to say you can only deduct 30%, NOL carry forwards up to 30% of your taxable income, which creates a huge problem for a lot of companies. When we've had clients who they've had their startup, they've had losses over a number of years, and then in year 7, 8, whatever, they either have a large amount of taxable income, not nearly as much as their NOL carry forwards, or they sell to whomever and have a big taxable gain at the entity level, and they can only use 30% NOL up to the extent they get 30% reduction of their taxable income. They end up paying tax, and in the cases where they sell, if the entity goes away, the rest of that NOL just goes away forever. So that's something we like to continue to bring up to make sure companies know that if you've been in a loss position in Pennsylvania, you have NOL carry forwards, you need to make sure that you're going to be able to use them, whether that's rolled out over years or whatever. So we just like to make sure everybody's aware of that.
Next up, ruined it for everybody. And then the last update here is that we have a new bonus depreciation form that Pennsylvania released. Us as tax practitioners are pretty excited about that. So just to give you a preview, the form on the right, I know most people probably don't care about this, but I'm so passionate about it, I had to include it here. So the form on the right is what we used to have to use. And as you can see, it's sort of a chart format, and you had to fill in numbers across that, like each row. And it was basically just very confusing. It didn't make sense. So we're really excited here because the new forms on the left, as you can see, they look a lot simpler. It's because they are a lot simpler to use. You're really just putting in your adjustments. So we're pretty excited about that.
And just a little insight onto that, we used to have to we knew what the right answer was at the end of the day, and we kind of had to back into that answer. Well, of course, the Department of Revenue couldn't follow the work, so we'd end up having conversations, and by conversations I mean letters that are spaced 45 days apart back and forth to finally get them the detail, and ultimately they'd always agree to it because they knew we got the right answer. But fortunately, somebody at some point raised their hand and said, this form doesn't make any sense.
Yep. So then we've got a few proposed legislation items going on here. First of all, there was House Bill 800. This was sort of a budget negotiator. It was in order to increase the EITC credits, which that's the Educational Improvement Tax Credit Program. We refer a lot of our clients to this program because it allows you to contribute to charities, but also get tax credits in return, essentially. It was vetoed by Governor Wolf because he stated that he wanted to focus on public institutions, whereas the EITC focused on the private and religious schools. So that was vetoed. We could see it pop up again. And then we've got the brewery tax. This was essentially just to make it fair for breweries that were selling their beer at retail versus selling to a wholesaler. So it's sort of a solution for an issue that was ongoing.
Just to touch on the EITC update, that is now in kind of a complicated fashion available to individuals. Traditionally, it's only been available to businesses. It is now available to individuals. You have to set up a special purpose entity or use one of the special purpose entities that have already been set up. But you individually can make a contribution, get EITC credits. And while it doesn't actually save you tax dollars, it does allow you to direct your tax dollars to where you would want to see them go.
Mm-hmm. Yeah, and that was actually legislation to increase from 110 million to 210 million. And what was interesting about it was that it had a provision in it that it would increase every year if a certain amount of those credits were applied for or used up. So that was sort of an interesting thing. And I think that's also partially why it was vetoed, though, because, you basically are saying you're going to increase it every year without really limitation on that.
It is tough to see how another $100 million would essentially be funneled out of the general fund and directed towards, I'll use the term special interests loosely, but everyone has their interests and they all think they're special. So we'll call them special interests.
Yep. And I mean, religious schools is also included that. So,
absolutely.
That's always going to be a political issue when anything like that is included. And then finally, for our last update, we have a tax simplification bill that was potentially we're going to be seeing here. It did a few things: combined state income tax return for an estate and a revocable trust, as well as eliminated the state inheritance tax for children under 21. And then more interestingly, I think there was an income tax reciprocity agreement between New York and PA. So we'll kind of keep everybody updated on what goes on with these, but they're just in the works now. So we'll see if anything passes. And now we have our first polling question. So we'll give you about a minute to go through these and see if you know what the Pennsylvania state insect is.
For those of you who didn't hear, polling question. You should be paying attention.
We want everyone to
right
get some
now.
credit.
I mean, we know you're all glued to your computer screens and you're not off doing something else. But if for some reason there was an emergency that you needed to look away for a second, this is our first polling question.
You know, I couldn't think of anything much more interesting, so I was hoping to get everybody's attention with this, so we'll see how that works.
Interesting that the spotted lanternfly is on there as one of the choices.
Why is that interesting, Mark?
Been hearing a lot about the spotted lanternfly. Apparently, it's an invasive species, not very friendly to non-invasive species.
You know,
So maybe you're giving a little hint as to that could or could not be the answer.
I honestly don't know.
Mark doesn't know the answer.
I don't know either.
Yeah.
Before we were reviewing this before the presentation, and Sharon mentioned that you can't transport firewood, because of the spotted lanternfly from place to place.
That's correct.
So perhaps that eliminates that answer. I don't know.
All right, well, we'll close out our polling question. Let's see what the answer is here. All right, well, it looks like a lot of people thought the firefly, about half of our viewers here. Well, those people would be right. Let's get our slide going here. All right.
10% of people picked the
firefly
Japanese
is.
beetle.
I just remember those always getting stuck in my swimming pool. All right, so let's take a look at how PA compares to other states in the current climate. So here I have a few charts. I think they're a little more interesting to look at. The first chart on the left there is showing the best and worst business climates. Now, it is focused on business there, but it takes a few different items into consideration. There's 5 types of tax that, this is from the Tax Foundation, sorry, I should say that. And they look at all different states and then rank the states based on their tax friendliness. So that could include the tax rates as well as how complicated it is to follow those tax rules. So they're based on individual tax, sales tax, corporate tax, property tax, and unemployment insurance tax. But those are weighted differently. And that was actually something where I had to look into that this year because the rankings changed from this year to last year. And the weight of individual income tax dropped in importance while the other types of tax increased in importance. The reason I say that is because we look at Pennsylvania's rank of 34. If you would have watched this webinar last year that we put on, it would have been 26. So initially that looks like a big drop, but it's actually really not, because the way they just changed the rankings, Pennsylvania would have been, I think, number 36 if the rankings had been the same last year. But essentially, Pennsylvania has that low individual income tax rate, which really bumped up their score in previous years. But with them changing the rankings the way they did, now that's less important, and Pennsylvania did drop in those rankings. But one thing to note on these slides is if you look at PA on that map, we're really surrounded by non-tax friendly states. I mean, even Maryland below might not have made the bottom 10, but it's number 40, almost in there. So what I like to note too is if you look at that chart, then you can kind of see too just where the tax-friendly and non-tax-friendly states are placed. A lot of those tax-friendly states are the ones that are missing one or more of those taxes. Obviously, that makes things a little bit simpler. All right, and now we'll go on to the impacts of federal tax reform on states. So when I start this section, I really like to start with how we determine what the effect of a federal change is on any state. And generally, that's going to be your starting point. Some states start with federal AGI, as they start with federal AGI and then they make their own adjustments to get to state income. Some states, such as PA for individual income tax, they really have their own gross income. They don't really start with federal income. And then other states start with federal taxable income, which is a little bit different than federal AGI. It takes some deductions into account there. And then on the chart on the right, you can see that's from the Tax Foundation as well, and it came out in January. It shows what type of conformity each state has. And notice there's only a few states that have that static conformity that hasn't updated to the current code, and those are the states in orange. Now, I have to note, I think Minnesota there is one that they have since updated, and that's just a comment on the fact that this keeps changing. You know, states are constantly updating their code. So even this chart that came out in January, now at this point, it's not completely relevant yet. But since that was the only one, I thought I'd leave it on. It's a good chart other than that.
It is interesting because we often forget how complicated PA's tax rules are. And because, you know, as this chart suggests, PA is one of the few states that doesn't have conformity across, you know, all the rules. And so, but we're just used to it. We just know, like, oh, well, PA taxes this, PA doesn't tax this. You have to have this adjustment in there for Pennsylvania, whether it's for businesses or individuals. So PA is very complicated. We often forget about it. Through our affiliation with Prime Global, we field questions from tax people all over the country asking, hey, I have this entity that goes into Pennsylvania, but I don't, what's all this stuff here? And we forget because we're just kind of like, oh, well, you just do this, 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 and this, and you're done. And they're like, say what? And so one thing to remember is Pennsylvania is a little more complicated, but as we saw in the previous slide, in terms of rankings for taxes, Pennsylvania is still a little better than many of our surrounding states. So if there's such a thing as tax mobility, you don't really have it unless you're going to move several states away.
It's true. That's very true. And the thing about forgetting, you know, how complicated Pennsylvania is, I would definitely agree with that. I tend to remember anytime somebody else has a question and I'm going to explain it and I'm realizing how complicated it sounds when I'm explaining it. But, you know, to me, it makes perfect sense. But the other thing, too, is you see PA on there is one that has selective conformity, which is sort of an oddball as well. They don't conform to everything, but they conform to some.
Yeah, a perfect example of that is when 100% bonus depreciation first came out in the Tax Cut and Jobs Act. Pennsylvania initially said, we're just not going to allow it. We're not going to allow any depreciation on these assets. And because whatever, and then you just wouldn't have depreciation, and then your basis would be higher when you sell the asset, so your gain would be less. Or if you dispose of the asset, you would just write off the whole value of it or the whole cost of it at that point. And everyone kind of spoke up and was kind of like, hey, this doesn't really make a whole lot of sense. You know, why are you doing this? Why don't you just allow regular depreciation? And it came out that the Department of Revenue system simply couldn't handle it. And since then, they've made adjustments and have allowed it. But that was a perfect example right there of just, you know, what are you guys doing and making it that much more complicated and that much more taxpayer unfriendly. But fortunately, we got at least a little something back.
Yeah, absolutely. So let's go into some of the specifics here. So first of all, one of the big provisions is the Section 199A deduction. You know, we all spent this tax season trying to figure all this out. But basically, it's a deduction for 20% of qualified business income, subject to various limitations. I'm not going to get into all the rules because that is its own webinar in itself. I'm going to focus on the effect on states. So essentially, this deduction is only allowed in computing and reducing taxable income. It occurs after AGI. So most states, as you saw on the previous slide, do follow AGI. So unless they follow taxable income, they will naturally not follow this deduction. And you're unlikely to see states that are going to jump in and say, well, we wouldn't normally follow it, but we're just going to add it in to follow this deduction. You don't see that happen too often. Although I will contradict myself here and say that my first point there is Iowa actually did do that exact thing. They decided they wanted to allow part of the deduction. So starting in 2019, they're allowing 25% of the Section 199A deduction. And
so you get 25% of 20%.
Exactly. Good job. But that'll
well
actually
done,
be well, it'll be increasing though, because it's going to be up to 100% by 2023.
Okay.
But they put a provision in there that's if they make enough revenue.
Which they won't.
So we'll see what happens with that one. The more likely case is the bottom there where you see Oregon and South Carolina decoupling from it, where they follow taxable income. So normally, you know, if they didn't do anything, they would follow that deduction, but they specifically decoupled. And then you have a few states as well that do follow taxable income but have not decoupled. So they'll follow it because they haven't done anything. Then we've got another big provision of federal tax reform, which is the limitation on interest deduction. So in general, interest expense is limited to interest income plus 30% of adjusted federal taxable income. Now, since this is taken into consideration in computing federal taxable income, again, most states which conform, federal taxable income, most states which conform will conform to this change unless specifically decoupling. So in general, most states will follow, and states have to decide what they want to do. If the state does follow that interest expense limitation, taxpayers need to consider how carry forwards are treated at the state level, as well as how consolidated groups are treated. So that's really, we can't go into every state here because every state might do something different, but there are a couple things to consider when you're deciding on how to treat this interest limitation when you're looking at other states, because carry forwards are at the partner shareholder level for pass-throughs, and the limitation itself is at the consolidated group level. So if a state has filings that are not consolidated, then they need to figure out what they're doing about that limitation.
And for those of you trying to keep track here, so far we have taxable income, and that's pretty straightforward. We have AGI, which is adjusted gross income. Well, now we have adjusted federal taxable income. So that's another thing to keep track of before we even start calculating these other deductions. So one thing to note here for 163J, adjusted federal taxable income today is your taxable income with an add back for your net interest expense and an add back for depreciation. So we're not seeing a lot of taxpayers having their interest expense limited by this. However, I believe it's in 2022, the add back for depreciation goes away. So your adjusted federal taxable income is going to drop dramatically in that year, particularly when you're taking bonus depreciation and everything else. And so we're probably going to see a lot more taxpayers having their interest expense deduction limited once that definition of adjusted federal taxable income changes.
So then we'll take a look specifically at Pennsylvania. Pennsylvania is one of the few states that actually have issued guidance on this. So in general, they've issued guidance that they do follow that interest limitation. However, they have a few specifications because Pennsylvania is not a consolidated filer. They have kind of given rules as to what to follow. So if you do not have a consolidated limit at the federal level, you don't even need to make a calculation for PA. They're saying if you don't have a limit at the federal level, we have no limit. You don't need to calculate a limit. You don't need to do anything, essentially. Now, if there is a limit at the federal consolidated level to that interest, then Pennsylvania has issued guidance that each separate company will need to recalculate what their limitation will be on that separate company basis. And then carry forwards, just in general, if there could be a different carry forward for federal and state for a consolidated taxpayer because of that different calculation that is done at the Pennsylvania level, you could have a different limitation, so you could have a different carry forward as well.
I'm so glad that the Tax Cuts and Jobs Act served to simplify the tax code for all of us.
Yeah. So then we go into the net operating loss deduction. Now we talked about Pennsylvania a little bit. It has that 35% for 2018 and 40% for 2019 because of the Nextel case. And obviously because of that, it does not follow the federal NOL deduction. As far as other states, there's varying responses to this. Some states add back the federal NOL, other states modify it somehow, and then some just start with federal taxable income before the NOL. It's, you'll have to look at each state or get your tax advisor to look at each state and determine what the rules are for that.
Yeah, the 80% of taxable income limitation at the federal level. The Tax Cut and Jobs Act eliminated alternative minimum tax for corporations. So this kind of backs us back to AMT by saying you can only deduct 80% of your NOL carry forward. So for those of us who are excited that there's no more AMT, there still kind of is.
I'm still kind of excited that there's no AMT, just to put that out there. But that's as a tax preparer, not a taxpayer. All right, and then our full expensing. So there's 16 states that currently allow full expensing, but the majority does not follow it. The 3 states in green there conform with partial add backs, but the chart kind of gives a good indication of which states do conform to full expensing. And Pennsylvania is one that does not. So if you can see, PA does not allow bonus depreciation. And for the 179 deduction for corporations, there's still a $25,000 limit on that 179. So that didn't really change with tax reform too much. All right, so this is in regards to the federal tax rule that limits state and local taxes deductible on Schedule A to $10,000. So many states were trying workarounds to this, allowing taxpayers to donate to a state fund and get a credit for taxes due. So essentially, rather than paying taxes, you're donating to the state, and then you get a credit for it. So it essentially changes the SALT deduction on Schedule A to a charitable contribution, and look at that, charitable contributions aren't limited to $10,000. Well, the IRS has issued guidance on this, and they are saying no to that. They're saying taxpayers must reduce their charitable contributions by the amount that they receive a benefit in state taxes. Now, on the flip side, they are allowing them then to take the amount as a state and local tax deduction if they're not already limited by that $10,000. And with this provision, the states that are most affected are the high tax states, such as New Jersey and New York, that were the ones that were essentially creating these funds in the first place. Now, there are exceptions here. The regulations provide exceptions for dollar state tax deductions that reduce the state income and not the state tax because it's such a small effect, and then tax credits for less than 15% of the amount transferred. Again, because they're essentially saying, well, then if you're doing it for only 15%, your purpose is not to avoid tax, you're just donating to charity.
And the key thing to point out there is the difference between deduction and credit. A credit offsets your tax liability dollar for dollar. A deduction lowers your taxable income, which is then obviously the tax rate is imposed on that taxable income. So deductions are allowed, credits not so much.
Right. So this could cause an issue for PA individuals contributing to a credit program such as the EITC, because that is even if you're getting a 90% or 100% credit, that will not, I mean, you'll still get that deduction on your state return. So there's no reason not to do the program because of that. However, if you have to reclassify, most taxpayers would classify that as a contribution normally. And really they're saying you need to reclassify that to state taxes that are subject to that limitation. And then we get to our next polling question. So again, we'll give you about a minute here, give you time to answer the polling question.
Wasn't Delaware the first state?
I believe so. But was it the first state to declare Independence Day a holiday?
You would think it might be, but
I maybe would have thrown in California or Washington State or something, just to help everybody follow along with the webinar, so they could at least eliminate one of those options.
Yeah. Yeah, or like France or Japan or something. or spotted lanternfly.
yeah. Or
Well, it doesn't
Washington.
say whose Independence Day.
Oh,
That's a great point.
That's true. Yeah. Could have thrown Washington, D.C. in there. Little trick answer, throw people off.
All right, and we'll get to those results of that polling question here. All right, it looks like the majority thought Pennsylvania at about 60%. Interesting. Nobody thought Vermont, though. All right, let's see our answer. Massachusetts, actually.
Yeah, you would have thought this was a Pennsylvania webinar, maybe, Pennsylvania takes a long time to do stuff.
Yep, a little bit of a trick question there, though. I agree with you. All right, now we're going to get into a pretty exciting topic of Wayfair v. South Dakota. I've been following this for quite a long time, so I'm, pretty pumped up about it, but maybe everybody else won't find it so exciting, but you should, because there's a lot going on in the states now. So just to give you a little bit of background on this, the previous rule was determined by QUIL, which was a case where essentially they said if you don't have any physical presence in a state, they can't make you charge sales tax to your customers if all you're doing is shipping items into the state and you don't have any other contact. So that was the rule back, it was 1992 was when that case was determined. So for the longest time, that was our rule that we went by, was if you were just shipping items and didn't do anything else, you don't have to file sales tax returns. Well, now South Dakota passed a law that requires out-of-state sellers to collect and remit sales tax if the sales exceed $100,000 or 200 separate transactions. So really, they passed this in contrary to that QUIL rule. And essentially, they were looking for it to go to court because they wanted that QUIL rule overturned, as many states did. And essentially, it went back and forth, but what ended up happening is that the court overturned the QUIL decision and ruled in favor of South Dakota and said that you do not need to have that physical presence in order to impose sales tax filing requirements. So where does that leave us? Because that was determined, well, even before that, states were looking to impose these rules because they were tired of, companies, online companies selling stuff into the state, and they get no revenue from that. So essentially, now that that rule has passed, we have just states jumping on board to create their own rules, if they haven't already, to impose sales tax filing requirements wherever they can. So this is the general rule. I've had to go back a couple of times as I created this PowerPoint just to check the rules again and again, because that's how fast these rules are changing for states. So it really is something you need to keep up with, because it's constantly changing. And there are very few states that don't have an economic nexus rule at this point that have a sales tax. And I have just Florida, Kansas, and Missouri. That's it. Everyone else with a sales tax has imposed some kind of rule like this. And you can see the limits vary. You've got those South Dakota copycats that are doing the same thing. And then you've got some higher limitations as well. There are a few trends that we're seeing right now. Some states have started removing those transaction level thresholds. You can see like there's the 200 separate transactions, and then you've got ones that only have the dollar requirement, and PA is included in that. Because I think states are recognizing that if you sell 200 $1 items, it's really not going to be worth making everyone collect the sales tax for that small amount, because it's pretty easy to hit that 200 separate transactions rule if you're making small sales of things.
And I'm always skeptical of the, we have Pennsylvania and Washington require notice at $10,000. So basically, if you get to that $10,000 number, you have to tell the state, hey, we're here. Well, guess what? They're going to come after you. So even if you don't hit that $100,000 mark, most likely if you hit 10,000 and you get on their radar, they're going to at least come in and start asking questions. And at the end of the day, it's probably just going to be easier to register and just start filing. Same thing with, where were we?
Washington?
Yes.
They did that notice and reporting as well.
Oh, yes.
And we'll get into the Pennsylvania rules specifically in the next slide. But we have seen a few states, it was before Wayfair passed. Well, I shouldn't say passed, I guess Wayfair overturned Quill, that states were trying to impose these notice and reporting requirements, because technically then they weren't going, they weren't breaking the Quill rule. They were still following it, but then they imposed these rules that made it make more sense to file anyway than it would be to try to keep up with the notice and reporting requirements.
And then you have California and Texas that throw this big number out there of $500,000. And I would have thought, they would have been going after this a lot sooner, but.
Yeah. Another reaction to this is not only then are states looking at the nexus, but then they're also kind of starting to look more at their own taxability rules. So especially like software as a service, we've seen a lot of states going after that, and a few more trends in what they're taxing now too. Because honestly, with taxpayers now being required to file in more states, hopefully we'll see that states start to kind of converge their rules, and we won't have so many varying rules, because right now sales tax in any state, anything goes. I mean, you can have different liabilities in different states based on what you're selling. So then looking at Pennsylvania specifically, before Wayfair, they did have that $10,000 notice and reporting requirement. And that was if you hit that amount, you had to send notice to the person you were selling the items to. You had to send notice to the state. It was kind of these complicated rules that made a lot of people just say, forget it, I'm filing. And then post Wayfair now, they have issued guidance that they have that $100,000 collection requirement. So if you are between $10,000 and $99,999 in sales, you have that option. You can either collect and remit or comply with those reporting requirements. But if you hit that $100,000 sold in PA, you are required to collect and remit. And now this is assuming you don't already have Nexus in PA in a different way as well. But PA doesn't have that transaction limit. And then worth noting is just the marketplace facilitators. A lot of states are enacting these rules, but I thought I'd just kind of note it. It's organizations that contract with third parties to sell their goods and services on their platform, such as Amazon, something like that, some kind of online marketplace. The facilitator is required to then register and collect tax on behalf of the seller. So we're seeing a lot of those rules going into place too, where maybe you don't even have Nexus, but you're selling through that marketplace facilitator and they do. So they're going to collect it on your behalf. You don't really have, luckily you don't have the obligation at least then, but you don't really have the choice as to whether or not to charge your customer sales tax. So finally, what do you do? Because, there's all these rules and we're talking about how complicated they are, but what can you actually do? And the first thing here is going to be review those number of transactions and the amount of sales with the transaction threshold, because In some states, they're getting rid of that 200 transaction threshold, but other states still have it. So you're going to want to make sure, even if you don't have the dollar limit of, say, $100,000, you could have 200 transaction, which technically requires you to file. Not only that, but then make sure you're not forgetting about your other possible nexus things. So if you have salespeople traveling into the state, if you're going into that state and doing something, those nexus rules still apply. So don't forget that there are other ways to have nexus other than just the sales limits. Another thing you're also going to want to consider taxability. So is what you're selling taxable in the state? Are you selling to a nonprofit where they are exempt from tax? You're going to want to make sure that you have all your requirements in place, such as if you need to collect exemption certificates, if you need to, just make sure what you're selling is being reported, if it's required to be reported, even if it's not taxable. And sometimes it comes down to a business decision. If what you're selling is not taxable in the state that you're selling it to, but technically their rules say that you're supposed to file returns, is it worth it to file those returns? That's something that business owners will have to consider, because, ultimately, if what you're selling isn't taxable, what's the state going to come back and do? Are they going to try to impose penalties on that? It's hard to say. It depends on the state. So now what happens if you discover that you do have a liability? What if you should have been reporting and you have not been? Oops. So first of all, don't contact the state. That is, I cannot say that enough. Don't make your first step to be contacting the state, because guess what they're going to do? They're going to say, yeah, you owe us some money. Not surprising. So the first thing you're going to want to do is, I might be a little biased, but contact your tax practitioner. See what they have to say about it. Or better yet, us. Yeah, hopefully we are your tax practitioner, but contact us, and we're going to look at those numbers, and we're going to see, okay, what's your potential liability here? Where's your exposure? And kind of guide you on the next steps. And one of those next steps to consider is a voluntary disclosure agreement. And we've done a couple of these for clients. They can be really helpful. Essentially, the state, they want people to come into compliance. So they offer these voluntary disclosure programs in order to help people come into compliance while allowing them to not pay extra penalties on the amount of tax that they mistakenly didn't remit. So essentially, you'll come up to code and you won't have to pay extra penalties, just like the regular tax and interest that you would have to pay. So it really does save some money if you come across something that you should have been reporting. And it's anonymous. So like I would contact the state on your behalf and, say I have a client who, this is their situation. They would like to come into compliance, and we can come to an agreement that way. So then some other things to consider are, do you have the processes in place to handle those additional requirements? So that's something in general. Are you able to handle these additional filing requirements if you find out you have liabilities in these other states? Or do you even have the resources to do this analysis? Can you, it is a lot of work to try to figure out what states are required to file in. And that's also where we can come in and help and kind of review your sales and what liabilities you could potentially have. And then finally, consider the impact of Wayfair on the sale or purchase of a business as well, because what if that business that you're considering purchasing might have a liability in a state where they're not filing? That's also a sale purchase issue as well. And we're to our third polling question. All right, the oldest gas station in the U.S. So I've given you a hint here. It's in PA.
Ah, shoot. That's going to be my answer.
And has anybody been there? Have you been there to the oldest gas station?
Oh, you're trying to get me to give hints here, because some of you listening know I'm from Lancaster. So,
Do they make it known widely that they are the oldest gas station when you go there? Do they remind you?
Well, okay, so I'll say I have not been to the oldest gas station, so that I do not know.
I believe there is one of the blue Pennsylvania heritage signs at the oldest gas station.
Ooh. I'm not sure I want to be known as the oldest gas station in the United States.
All right, we've got a couple more seconds. So get your polling question answered if you want CPE credit. All right, let's see what our results are. Oh, fairly even between Philadelphia, Altoona, and some Lancaster there. All right, interesting. Let's see what our results are, or our answer. Okay. It's Altoona.
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 Interesting.
Sharon knew that, by the way.
Yeah.
Yes,
Right?
I'm a Roadside America fan.
Oh, cool.
Nice. I definitely would have guessed Philly, I think, if I would have. Although maybe that's the too obvious answer, because, you know, Philly you would think,
Mm-hmm.
being a bigger city, but nope, it's Altoona.
I wouldn't think there would be enough cars in Altoona for a gas station.
Right.
That's just my
It
thought.
is a little surprising, but I think it said like 1908 or something like that was when it was put in. All right, so now we're going to pass it over to John and Sharon from Harbor Compliance. So I'll let you kind of introduce yourselves again, and then Mike is yours.
Great. Yeah. So, well, first of all, thanks so much for having us, guys. This is really cool to be here. I'm John Beck. I'm Director of Market Strategy at Harbor Compliance. I've got about 15 years of pretty in-depth experience in corporate legal services. At Harbor Compliance, I'm in charge of marketing, help out with content, partnerships. I like to participate in thought leadership initiatives, and I dabble a little bit in business development as well. I do a lot of different things. Sure.
And I'm Sharon Cody. I'm the partnership manager at Harbor Compliance, and I'm tasked with developing strategic partnerships to promote compliance best practices. And I have a legal and nonprofit background. So we're happy to be here talking to you. John's going to give us some information. Now that you've talked with your tax professionals, hopefully those at McKonly Asbury, and found out that you have nexus in some states and need to be worrying about some Wayfair payments. What other additional regulatory obligations do you have?
Yeah. So I should take a step back. At Harbor Compliance, who we are as a business, we're located in Lancaster, Pennsylvania, right down the road. One of the answers in that last question, the incorrect answer, but one of the answers. We are a company whose mission is to help businesses achieve total compliance in the fewest steps with the least amount of effort at the lowest long-term cost. So what we do is we manage a full range of government requirements associated with forming, operating, and growing businesses or nonprofits nationwide, everything from corporate filings and tax registrations to professional licenses and operating permits. So that's our business. Growing rapidly. We were Inc. 500 this past year, so we're pretty proud of that, and a local business as well. But again, operating nationally. So starting out with the Wayfair case, South Dakota versus Wayfair, Lindsey did a great job of explaining all the detail in that, so I won't get too into that. The important thing here is, you know, looking at it objectively, just the nature of business and how things have evolved. If you're like me, you probably have an Amazon delivery truck at your house every day. I probably have one there right now, as a matter of fact. Business is evolving, and the physical presence rule that was governing interstate commerce for over half a century just has become further removed from reality. And it's estimated that the revenue losses as a result of how these businesses are structured and the commerce occurs is anywhere between $8 and $33 billion annually to states. So you can imagine why states like South Dakota dip their toe in, and why all these other states have quickly followed suit, and things are happening quickly. Sharon, you had a statistic about the number of states that are projected to be on board in the next few years.
When I checked yesterday, I think 36 states and Washington, D.C. are scheduled to be on board with their new Wayfair rulings by January of 2020. Some are already in place, some are pending before their legislature. So it's a really rapidly changing environment that you need to keep an eye on to assess your obligations. But we can help.
Yeah. So we wrote a blog article last year, actually, as this case came out, and we got a lot of interest and inquiries and companies just wanting to understand more. And ultimately, in terms of determining a tax nexus or a legal nexus, you should be reaching out to people like McKonly Asbury for the tax opinion, or to a law firm. But it raises interesting questions, and the important point is that it's constantly evolving, and it's going to continue to evolve. So it's something you should keep an eye on, even if you're a small business. As we saw in Lindsey's presentation, there are a lot of businesses that don't meet that revenue threshold, and in some cases you might have to file an exemption. That's still something that you have to do, and it has to be maintained year over year. So it's just something to take a look at and be mindful of. So what we find is that, and what a lot of the companies who come to us are needing, is that they've determined that they do have nexus, or that they do require nexus in a state in which they don't have a physical presence, and they need their entity qualified there, and that is what's called foreign qualification. It can also be referred to as a certificate of authority, certificate of registration. There are a number of different names for it, but essentially you've got a company that's formed in one state. Mark referred earlier to the Delaware holding companies with the Pennsylvania qualifications. You've got a company that's formed in one state, and it expands into another state. And there's a number of things that have to go into that. So you could be registering a general corporation, an LLC, and there are, aside from Wayfair, considerations that you should take in place when you're considering whether or not you should or want to foreign qualify an entity. Things like generating revenue in a new state, owning or purchasing property in a new state, having employees in a new state, paying taxes in a new state. These are all things that might trigger foreign qualification. So,
having employees, that's a really big one that we see, because it's so easy to have remote employees now, and you might see employees in different states, and a lot of businesses don't realize that means that they have to register.
Yeah, it could, or in a minimum, at a minimum, I should say, it just calls into question. And you should talk to Lindsey, you should talk to Mark, you should talk to the professionals, right? So once you've determined that you need to foreign qualify, you got to put together the appropriate paperwork and file it, and the state fees that are associated with that have to be paid. We can do this kind of work. We do it all day long. You're also going to require what's called a registered agent, which is a legal presence within the state. If you don't have a physical presence, you're going to need a legal presence within that state in which you're foreign qualifying, who's there to receive tax notices and service a process or lawsuits. That's something else that we do. We do it on a nationwide basis. So in terms of the process, we already talked about that. So what are the things that that need to happen when you are foreign qualifying? 65% of the time, we find that you are required to pull what's called a certificate of good standing from your home state. And it needs to be pulled within a minimum of 6 months prior to the qualification. So what I mean by that is, if it's a Delaware corporation and it's qualifying in California, California is going to say, hey, that's cool that you want to do business here, but we want to see from the state of Delaware a certificate that says this legal entity is valid and it's up to date and it's paid its taxes. So 65% of the time it's going to require that. 6% of the time it's going to require actual certified copies of the articles of incorporation. So we want to see that paperwork, that original paperwork that you filed in Delaware or Pennsylvania. We want to see that here in California. And then there are a few states that actually require both certified copies and a recent good standing certificate.
And don't forget, there's a couple states where you also need to publish in a newspaper once you're starting to foreign qualify there. So New York is one of the ones that makes it even more challenging.
Yeah, it
really varies from state to state.
State to state, in some cases county to county. It's quite a pain in the butt. So, but it's something that needs to be dealt with, and it's something that certainly we can help you out with. We have seen recently some penalties associated with doing business without registration. There are a few states that jump out: Texas, Florida, Connecticut, Delaware, Tennessee. Florida in particular, we've seen recently some penalties of up to $700 a year if it's found that you've been operating a business without properly registering in that state. So again, just something to keep an eye on. Okay, So then once you are actually registered in the state, you're going to have to keep that legal entity active year over year. And that's what we refer to, the filing that's associated with that. We refer to that as Secretary of State annual report filing. And this is, of course, also something that we can do for you. Some quick facts about annual report filings. When are they most commonly due? So annual report filings can happen any time of the year. Most commonly, they are tied to the anniversary of formation. So if you form an entity in May of a year, your annual report renewal is generally going to be somehow tied to that May date in the following year. We form a lot of entities. We do find that most commonly entities are created in the first quarter of the year, but not by much. So about 30% of entities are formed in the first quarter of the year. The highest renewal month of the year that is not tied to either an anniversary or a fiscal year end, we find is April. So that's when states are most commonly renewing their annual reports. Probably has to do with, lining up with the federal taxes and giving businesses an opportunity to close their books in the first quarter. But that's what we find most commonly. And then if we exclude the anniversary and the year-end dates, 80% of the annual reports are due in the first half of the year, those Secretary of State filings. We actually, it will be provided after the webinar today. We're going to give a handout that is our ultimate guide to annual report filing, and also our ultimate guide to foreign qualification. And it basically shows you state by state what's required, what the fees are, when it comes due, everything you need to know. So it's really helpful information, and it'll be there at your disposal. Annual reports, in particular, what information is required. Oftentimes officer director information, member manager, ownership in general, purpose statements. Those are all really important things. Stock information, authorized shares, par value, etc. Virginia, Illinois, Delaware, and Arkansas take issued stock into consideration on their annual reports. Maryland and Wyoming in particular take into consideration the assets that are held within those states. So those annual reports are a little bit more tricky than the standard just pay a fee and submit a piece of paper. And then the question is electronic or paper. Again, the way that business is evolving and even government is evolving, the vast majority of states at this point accept electronic filings.
But not Pennsylvania.
For some types of filings, not Pennsylvania or Texas, for that matter. So they go by different names, what we're referring to, the Secretary of State annual report filings. In California, you may refer to it as a statement of information filing. Indiana, it's a business entity report. Georgia, annual registration. Delaware, it's the annual franchise tax. Nevada, it's the annual list of officers. So all different names, same function. They happen sometimes at different frequencies, different times of the year, different fees, but it's all sort of the same thing. And it's something that we're going to provide, again, this handout that can give you a comprehensive nationwide blueprint to filing annual reports.
So you can track the obligations in the states where you have nexus.
Yeah, absolutely.
Thanks for letting us hop on.
Yeah.
Yeah, that's perfect. Thank you both for joining us today. And we're going to wrap it up. So thank you, everyone, for listening to the webinar. Again, we've got Mark Heath here, myself, Lindsey Waltemyer, and joined by John Beck and Sharon Cody. So thanks again. Hope you all have a great rest of your day.
Thank you once again for joining us for this webinar recap produced by McKonly Asbury. We hope you join us for our future webinars. You can stay connected to us and learn more about all of our upcoming events by visiting us at macpas.com. Thanks again and have a great day.